So it's been a somewhat positive year as we thought we'd see. Election years are usually somewhat positive, somewhat steadily moving up. I think the expectation was a little more sideways, but it's going well so far, so can't complain. And it is spring, and I do love spring, so it's my favorite time of year. All right, long-term trend. I actually have a shorter term on here as well, but it's been steady. Money flow has been steadily coming into the market really since last November. Not huge. I mean, it was really the big rush of it happened in November, December last year. And it's been okay this year, but it's not been as strong, but it has been steady, and there's really nothing wrong going on. It's just not really exciting anymore. Really, the quick money has been made, and now it's just a slow grind. There's always issues that we could be looking at where something could go wrong, but at the moment it seems steady. I'm not too concerned unless something comes out of nowhere that we're not expecting, but that is not expected at the moment. So yeah, long-term trend still somewhat in place. Money flow is backing it up. No reason to not be somewhat invested at this point. Fully, I don't know about fully anymore, but certainly somewhat. Midterm cycle. I think this backs up that as well, because back here in November, money flow was huge into the market, and that's when the market really took off back in here. And then oddly, it was really bad in January, but it really didn't sell off too much. And then since then, it really hasn't been that strong. And this is actually almost back to zero today. So money flow is not huge. It's positive. There's a slight positive bias. We're not in a runaway positive market. It's just steadily growing, and there's nothing wrong with that. It's kind of nice to have a break sometimes of nothing too crazy going on. So money flow is good, but not huge. I'd love to see it push above this 200 again. Just really see something run. Though really, I'd almost rather see a break for a little bit and then something we can buy back into that can move higher faster, because faster is much more fun. Last month, I left last month on here because I thought it was interesting how this has gone back and forth the last 3 months as far as where leadership is, right? So we're back at leadership being the S&P over the NASDAQ, just of those two. Last month it was NASDAQ. Month before it was S&P again. So it's just back and forth where there's not this strong leadership in the market. And part of that is if there's leadership and strength on one side that stays strong for a while, you tend to get good runs in one or the other direction. But if it goes back and forth, it's like, we're good. Oh, no, we're not good. And nothing really happens. It's just a sideways kind of a grind that's not terribly exciting. Large cap has stayed the same. Now, that's actually the same as NASDAQ and S&P. That's like two halves of large cap. Large cap is really where you want to be, and it's just really like what part. And leadership has shifted. The things like Apple, which really dominated the last year, and the run up looks terrible this year. It's actually down a bit. Nvidia got hit pretty good last year. I don't know where they are now. They might be recovering and doing okay-ish, but a lot of that leadership from last year, Google is another one that they're just not doing well this year. So a lot of other stocks are kind of catching up at this point. Maybe that's good, but that also feels more like the end of a run rather than the beginning, or at least the latter half. This could continue for a little while. And then, of course, small is better than NASDAQ, but small is having a terrible day today, so it gives up very, very quickly. And then we're back to value over growth. Again, before that, we were in value again. So the value growth thing goes back and forth and back and forth. And I'd love to see it stay one side for more than a couple weeks, because then you have a trend you can be on, and it will move, and you can stick with that a while. And then our leverage, two pieces, it just shows that the leveraged fund is better than the index. So the 3 times S&P is stronger than the 1 time S&P. And that's really all I'm looking at. I found that gives me some interesting insights, whether the market is there momentum behind the moves. And there's enough to justify these two still being green. So far, so good. All positive. All sectors are positive right now. There's a couple, a lot of negative cracks coming up on the MACDs. Healthcare and communications, which is a lot of the big tech leaders from last year. Industrials are going negative. That makes me wonder about the Dow, and if I might look at shorting it sometime in the near future. At least it's a hedge against other things. That might be something that we're looking at. Does it actually happen? I don't really know, but this has me thinking about it. If industrials are weak and a couple of other things in that space. Financials has gone positive. And then this half, energy is really the one that's running away right here. And seasonally, I was expecting to be mid-month to later, so maybe it got ahead of itself. I don't know if we missed it. I'm certainly watching for an entry. I'd love to have a little bit of energy exposure, certainly in this time period. Going into spring, into early summer, it's usually the best time for energy. The rest of the year is actually not very good historically, but certainly something we're looking at. But we may have missed it, and if that is, we just have to let it go. But it's something we're watching as well. Utilities being strong. A lot of this stuff is the more defensive. I also don't love that either. XLP XLF. Everything on this top half are tend to be the more defensive players, and if that's who's leading, that's typically not very positive for the market. Because in the years, a couple years ago, in 2022, when the market had a very big sell-off, those were the strongest ones there as well. While the technology companies and the communications and the big tech really got hit the most, and that makes for more of a weak market. So this isn't inspiring that we're going to run away, but it's not necessarily bad because they are still on the positive side. Uh, in questionable markets, we get a more of a mix on the negative versus positive. So far so good. I'm not super concerned yet, but that's where we are. Rotation. This has been funny because usually, I kind of call this ducks going around the pond. They typically go in this full circle around all four squares, from improving to leading to weakening to lagging to improving. And that just cycle continues through the sectors. Right now, they're just circling between leading and weakening and leading and weakening, leading, and not much is really going on here. I post these on Twitter weekly, so if you want to see the current status, you can do that. You can also scroll through and see the history. It's kind of fun to watch. There hasn't been a lot of reason to weak. As these pull into weakening, the expectation is for them to move into lagging, but they just haven't done that. So once that does happen, that's where a market sell-off should happen. But we're just not seeing it. I can't. I've been watching this for years, and I don't really recall it ever just staying like a little tornado hanging out in this section. It just won't go this way into the weakening, or the lagging, and that's not bad, but it supports a positive market for now. Is it crazy strong? Again, it's not, but you can't fight positivity. This is from this morning. I thought it was very interesting. A lot of bond sectors have a lot of orange, so that's moving them into the yellow box previously, and then our directional momentum is also not great suddenly on them. That would put them on the weak side. So the only things positive as of today are the high yield munis, preferreds, floating rates. We own on our bond side, we own mostly floating rates and munis at this point. A lot of this other stuff we don't. We have a little bit of ag related, which isn't great. We'll probably have to sell that, very instantly, because yesterday these were all green. It was all green and good, and suddenly just like a big wave. Here we are looking at everything being a little bit iffy all of a sudden. Now these aren't red. That doesn't mean it's time to necessarily get out, but it's time to start watching them and seeing if something is going wrong in that space. And it happened all at once across a lot of sectors. And that's interesting. Certainly high yields, the treasuries, both types of treasuries, and a different section of munis are iffy. So something to watch. And that was from an hour before we're going live with this presentation. So that was worth a look because it was so drastic of a change and so immediate. And then we've got the PE ratio. I haven't shown this in a while. Last time I showed it, it was actually at this peak. So I hope that's not foreshadowing of where things are. But typically when valuations are this high, this was before the tech crash. This was before the 1929 mega crash back in there. When valuations of the stock market are this high, it's generally not real positive for continued growth. It might be in the short term. This could still run up to where that was. It could run up to where that was back in 2000. I don't think it will. I think more likely what would happen is a market pullback would bring these down to a more reasonable level, and then we can have a good run from there. I mean, ideally, we have a really good sell-off that puts us down into this 10 to 15, because historically, when it gets down into there, you get a multi-year run that's very, very positive and very easy. You just, put your money in the stock market and let it ride, and it's going to be great. And that can happen for a decade. But when valuations are way up high like this, you've got to be active. You've got to be tactical. You've got to be watching every little turn and say, okay, something goes wrong. You've got to be quick to get out, because something, you don't know how far it's going to go. You don't know how bad it's going to get at that point. So that's really where we are conceptually. Again, right now we're fine. This election year could stay fine as well. The history of election years, specifically going back 96 years, every election year. So typically not much happens through May, through June, and then you get a good run July, August, and then it's a little September, October is always iffy, so that's as expected, and then November, December could be good. Again, it depends who wins and how that goes. That throws in a whole different bucket of issues. But as of right now, I don't expect to even really hear about it affecting the stock market or the economy, probably not into this area anyway. So I think it's very likely that we see this grind. Even though this says the market should have been down this last little bit, it's actually been flat to up. So maybe this up part becomes the down part. Either way, it's not expected a lot to happen. And that's really where we've been. The NASDAQ is actually where it is, exactly where it was on the 15th of February right now. So we really haven't gone that far. Then there's the possibility of a drop in May and before things good. So I'd love to see a drop if it's in April, if it's in May, if it's in June. That would be a great setup to have a really good run through the summer. And that's really what I'm hoping for. And then we'll see where it goes from there. And then we'll know more clearly about the election and where things could go for the year after, because the year after an election is usually not so great, and that'll be a whole different thing for another time.